Can you get more than 75% loan to value on a buy-to-let purchase? Good for you. But yes, so really good question to kick things off with. Can you get more than 75% loan to value on a buy-to-let purchase? Yes, you can. Before lockdown, or before lockdowns, the first lockdown, it was pretty common. Most lenders had an 80-85% loan to value product. They're a bit expensive. You know, someone like Kent Reliance, for example, they would charge like 5.29% or something off the top of my head for an 85% loan to value mortgage. When lockdown happened and the market sort of went and sucked in, that was a horrible sound, wasn't it? I'm not doing that again. Condensed down a little bit. One of the first things to go was loan to value. You know, suddenly the norm for the market was like 60%, and we slowly crept back up to 75%. And more recently, we are starting to see a few 80% loan to value products, and I think there's one or maybe two 85% loan to value buy-to-let mortgage products back on the market now. But there are two things that I would warn you about using a buy-to-let mortgage above 70% loan to value. Okay, so number one, the first reason why it might not be a good idea is that when you become a portfolio landlord, so that's when you own four or more rental properties, investment properties. You fall into this new bracket known as a portfolio landlord, and this is where the PRA, the Prudential Regulatory Authority, they're the governing body that look after investment property finance, basically. So your residential mortgage is looked after by the FCA, the Financial Conduct Authority, which is the main governing body in the UK, but the PRA look after everything else, basically. And they come up with this new concept of the portfolio landlord. What that means is that lenders have to do a little bit of additional checks on you as an individual, on your portfolio, on your background, and not even your background, on like your future plans. You have to actually, a lot of lenders they make you fill in a business plan, which is absolute bollocks, actually. It's a one-page document, and it's literally like, what are you going to do over the next few years? Going to buy some properties, I think. Great. Sign that at the bottom, done and dusted. Complete waste of time. Anyway, that's just one of them. But the main one is they will do a stress test of your background portfolio. So if you're buying a property normally and you're not a portfolio landlord, what they'll do is a rental stress test on your property that you're going to be purchasing or refinancing, and the rent will determine whether they can get you to the loan amount that you need. When you're a portfolio landlord, you can pass that assessment, that rental assessment on your actual, yes, they are absolutely horrible forms, Beth knows this, she's a broker. They're just pointless. They're just absolutely pointless. But anyway, back to the matter at hand, which is they'll do a rental stress test of your entire portfolio in the background, not just your security property. And generally speaking, if you're, it's not, this isn't a hard and fast rule, by the way, guys. You know, there's no real kind of, every lender is slightly different. But rule of thumb really is if your portfolio is leveraged, i.e. the loan to value across your portfolio is higher than 75% loan to value, there's a decent chance that it's going to fail this assessment. And what that means is you could be perfect, as many of you are, and your property that you're buying or you're refinancing could be absolutely fantastic, but they're still going to decline the application, which is so frustrating. So try not to over leverage your portfolio, basically. I always tell my clients, let's keep it at 75% unless there's a really, really good reason for it. So that's the first reason why you might not want to go for a buy-to-let mortgage more than 75% loan to value. The other reason is the rental stress tests. Okay, so you think about the more you borrow, the higher the rent needs to be in order for you to fit within the lender's rental calculator. So even if you are purchasing even if you're using a 5-year fixed rate where they'll use the pay rate as part of their rental calculator, you're still asking for a large loan amount in comparison to what the rent is likely to be, because don't forget, the yield's still exactly the same. The annual rental income as a percentage of the value of the property, that remains the same. but how much you're trying to borrow, what your loan size is going to be higher, and therefore it's harder to fit within the lender's rental calculators. So a lot of the time, lenders will say, yeah, we'll lend you 85% loan to value. Whether your property actually will allow you to get to 85% loan to value is another thing entirely. So that's something that you really, really need to think about before starting applying for these loans, because it might actually come back and go, actually, no, you can't get more than 80 or 77% loan to value. And then what happens is you're borrowing just 2 or 3% more than you would on a 75% loan to value product, but you're paying for an 85% or an 80% loan to value product, which is pointless. Why would you waste that money? So for the sake of putting a little bit of extra deposit in or pulling a little bit of less money out, generally speaking, it's the better option overall. So there might be some times that you need to, but on the whole, it's best not to. So answer to the question is, can you get a more than 75% loan to value on a buy-to-let purchase? Yes, you can. Do you want to? Maybe not.